Every journey begins with a single step. For many, the first step is the greatest challenge. Yet for all, the obstacles, the doubt, and conviction teach us about ourselves. It's these moments in life, a test of our abilities, our mind, when we don't know, but we still proceed, driven by the unspoken, but ignited by the obsession that yields some of life's greatest lessons and rewards. Join me as we explore incredible stories of leaders forging industries, enterprises, and ultimately, themselves. I'm your host, Adam Geary, and welcome to Capital Class. Let's begin. Classmates, today we are in for a real treat. Not only are we covering one of the more coveted topics of venture capital, we're doing it with an incredible person. Today's episode is a return to one of our original topics from episode 2. The venture capital and private equity are a unique term, often stated VC or PE, but rarely understood. The glitz and glam of being an investor understates the gritty reality of placing careful and calculated bets on the future state of companies, generally long before they've even reached profitability. The industry norms indicate that 54% of these investments fail, 36% return 1 to 3x, and the almighty 10%, they return the rest of the fund. To carefully sift through these opportunities is to be a scientist, a futurist, and a realist. On today's episode of Capital Class, we are joined by Ryan Whittemore, partner and chief investment officer at Florida Funders, a hybrid venture capital fund and angel network. Ryan, welcome to Capital Class.
Thanks, man. But why'd you wait till episode 30 when you said you started this discussion on episode 2? I thought I knew you better than that.
Well, we bring a lot of different voices on the show, and for me, I felt like now is the right time to have you here with playing both a critical role in some of my very first deals, but also as we enter a junction in the VC market, right? I think you've joined during a period of renaissance, right? 20 years ago, only a very small subset of investors ever even reached PE or VC. Yet today, people invest in these markets from the comfort of their couch. As a fund manager, give me some perspective. I mean, how has the market changed even in your period of time leading Florida Funders?
Yeah, I mean, we've had some pretty wild years the last couple of years, with COVID, and the pandemic, and now the Valley banking crisis. Seems like there's always something. And, throughout that pandemic, people were moving around. And so, when I started my career back in 2000 in finance, I can very vividly remember talking to my college dean, and I was telling him kind of what I wanted to do. I'm not sure I really said venture capital, but I really didn't know what it was or even that it existed. And he's like, basically with your degree, you're going to be able to be a wealth manager. And so that's what I did, and the reality was there were so many other things out there, and, not many people talked about venture capital and private equity back in the early 2000s. And then, the dot-com boom happened and dot-com bust followed that. And, nobody wanted to be in VC at that point for a while. And so, and I stayed here in Florida, and there really was hardly anything for the longest time, but it's kind of a giant sleeping giant here in Florida. And, we always knew, the people that were here, that it had all the right elements in terms of a great place to want to build a business and live a lifestyle, raise a family, all those things. But, it takes multiple aspects to build a tech ecosystem, and you have to have each one of those legs to stand on, or it really doesn't work. And so you need founders willing to start companies, but they need to attract talent, and the talent has to want to come here. And in order for the talent to come here, you got to have capital so they can hire it. So it's like the capital doesn't want to come here because there's no companies, and they're skeptical that there's any talent. They don't want to bet on people that can't hire the best talent. So for the longest time, even the companies that we did find that were great, you talk to some of the West Coast investors and they say, well, you might have a good company, but there's no talent there and they can't hire anybody, so we're not interested in investing. And then all of a sudden, everything switched in the pandemic, and everybody, it finally became okay to kind of be really anywhere and work anywhere. And you had this flood of people that were extremely talented coming here, seeing other people who are already here and talented and thriving, and saying, "Wait a second, it can be a viable market here." And that snowball just started happening, and one led to two, and two led to 10, and 10 led to 100, and next thing you know, like, this is the hottest place to be in the U.S. for starting a company and for investing. And so you're getting more and more companies coming here every day, and you're getting more and more funds coming here every day. And so now you've got this baseline that's kind of, I would say, not only sustainable but thriving and rock solid, to where I don't see Florida going away on the map. But that gap between us and Silicon Valley will probably never be equal, but it's gonna continue to narrow.
You think the market's slightly over syndicated? And I ask this from the lens of, at least in education, right, which we spend a good chunk of our time. There were a handful that used to dabble in this. And not that long ago, I saw a kind of an overview of funds I had never even heard of. I mean, hundreds of them that invest in education now. And I wonder if you're feeling that, or if that's just, maybe just a bit of my own lens.
Definitely, it definitely depends on the lens. You talk to the founders, and there's never enough capital, but a lot of them just don't have, either they're not pitching it right, or the business isn't right for raising capital. And they've got great businesses, there's nothing wrong with it, but they're just not set up for venture capital. So, depending on who you ask, really kind of answers that question. But I saw a stat the other day that there's just over 5,000 funds now in the U.S., venture capital funds, and the majority of that, the bell curve, if you will, the heavy end of that is going to all be on the earlier stage. So there's a lot more early stage, seed or seed to Series A type of funds, and then it takes a lot to do a later stage fund, and so the dollars aren't that bell curve. The dollars are much heavier weighted towards the big funds, because they're raising $1 billion plus funds. But there's only a select few with a track record enough to be able to raise that kind of money and be able to do those kind of investments. So, there's a select few on that end, and then there's a lot on the early end. So it really kind of depends on where you're trying to raise. But I think that this market is flushing a lot of people out. Strategies are getting busted. You can't just throw money at a wall and hope it sticks and see if that works. I remember a very prominent fund. I mean, we're about to do our first close on our third fund, which will be $100 million, which for Florida is huge. It's a nothing out in the West Coast, but I remember meeting a fund, and this guy was in an $80 million fund, and a deal that we did. The only diligence the guy did was have lunch with his founder, and he wrote a $3 million check. And to me, that's just absurd. But out there, it's just a drop in the bucket, and you're throwing stuff at a wall and seeing, and hopefully you get a unicorn that writes back the fund. We do things a little bit different, and that's okay, either way. But it was pretty eye opening to me, because it was one of the earliest deals I saw, and I couldn't believe people are investing someone else's money off of a lunch meeting, and that's the only due diligence you're doing. To me, that's absurd.
Look, I'll follow on to this. We are the recipient of these investments,
Yeah.
right? Where a company will be invested in, and they'll come to us and say, hey, we took all this money, and now we need to do X, Y, and Z. And we're sitting back like, who would invest in this? And at one point, I mean, certainly in 2021, our number one issue for client termination was acquisition, which is like, it's an interesting market. Obviously, we believe in it, but the idea that all of these companies were going to become unicorns, that they were all worth these kind of bizarre valuations, I have wondered if it tarnishes those in the market for the long run, right? That, like, there are people that are maybe they're playing fast and loose, $3 million checks over lunch. Like, what does that do to the industry? Where someone like yourself, I mean, you're a professional, you're in it. This is what you do. This is your career. Do you feel any of that?
Yeah, I mean, it's kind of like I don't know. It's like anything where you start to see some momentum, and you start to see less and less professionals coming in chasing that dollar, and it can be sustainable for a little while until it breaks, and then it's not, and the people that don't know what they're doing get flushed out, and they get flushed out pretty quick. I mean, for us and really for anybody in this business, I'm not gonna say it's easy to raise a first fund, but if you know people and you have a thesis, maybe you came out of a company, like you came out of Google or something like that, or a startup that was really successful. There's a lot of people that raise money that way. The question is, can they raise that second fund? And generally, you've got to have some traction that shows what you're doing and you know what you're doing. Um, a lot of people, it's interesting to me because I see so many track records are built like, oh, I invested in Uber, and oh, I invested in, Facebook and all this stuff. And you look at what they did, and they invested at like the Series F, and they got an allocation through somebody else, and it's like they just kind of can put that logo on their thing, and nobody really, a lot of it's just as much as I see investors that don't do diligence sometimes. Not, we're talking about a smaller subset. It's not the
Sure.
majority. But you see a lot of LPs, the investors that do the same thing, like especially the big pension funds. Like it's scary how traditional they are. They only want to go with the biggest names, but they don't look at like what their strategy is or how did they get into Facebook or how did they get into Uber, and they got in at the latest round at a 2 billion, $5 billion valuation, or hoping it can go to 10 billion or 20 billion in order to make their returns. And this market specifically, which I've been in business for 23 years now. I haven't seen this really since 2001, where the bigger bets, the ones that had kind of made it out of the gate, the horses that are kind of approaching that finish line, all of a sudden you're finding out like those are the ones with the most risk, because the idiots who bet on it last time, were betting on a $10 billion valuation on a company that's still not profitable yet, and it's just a pure speculation. Who can be the last one in the chair kind of thing, and now all of a sudden fundamentals take over, and they're saying, wait a second, this company that's worth $10 billion that's doing 500 million in revenue and is unprofitable, that's probably not worth 10 billion. And if it is, like, the only reason it's worth 10 billion is somebody's willing to buy it, or they can IPO it and investors are willing to invest at that price and kind of keep it there, and I think that floor is falling out of that market, so it's compressing the later stage people and flushing out the people that really never knew what they were doing, but were just had enough of a open door to access to somebody to be able to throw some big name on their cap table and look like they know what they're doing.
It does feel like there's a return to fundamentals.
Yeah, I mean, absolutely. We've always been that way. That was kind of something, when they, I'll say, gave me the keys a little bit to the process here. I just, at the end of the day, the way I look at it is we're investing in businesses, and we're not investing in fads. We're not investing in, speculation. We ultimately have to kind of forecast where stuff is going and what this business could become, but it's built off of something, like there's a reason why we feel strongly about the founder and why we like the business model, why we're selecting this out of, we'll look at 2,000 deals to do 1% of those. Might do 15 to 20 deals a year. So that top 1%, like what is it about those top 1%? And to me, like it's not necessarily that we're saying, hey, it has to have this fundamental. We're looking for like a solid business with some traction, hopefully, and something that's pointing to why they'll be able to grow traction, or like sustain and grow traction, but also like looking at the margins and like, okay, like how does this turn into a business? I don't care if they're profitable right off the bat. They probably shouldn't be at this stage. They definitely shouldn't be. But can they become profitable, and what does it take to get there, and how many people are they going to have to hire, and like how much development is it going to take to get there, and then on an ongoing basis, and is that a sustainable business, and is that business going to be attractive to somebody to eventually buy? Very few are going to ever IPO. I mean, I don't, if it does happen, fantastic, but I never go into it counting on that as like the likely outcome. there's so much damn money in private equity, and these big strategic companies that you hear about the money on Apple's balance sheet and things like that. There is so much money out there that it has to have somewhere to go, and we might have not much happen in all of 2023, but deal makers are itching to do stuff, and patience only lasts so long, in my opinion. So as soon as you start to see the all clear sign, down the road, people are going to start doing it, and you're going to start hearing about people doing deals, and that's going to make more people come out of the woodwork, and they're going to start to do deals, and all of a sudden the green lights, you're waiting for the green light, and there's already 50 cars that have taken off at the race line. So I think it'll be as fast as everything kind of came on and slow down, which wasn't a surprise. The Silicon Valley was a surprise, but all the economics around everything, not at all. It shouldn't have been a surprise to anybody. But I think same thing will happen on the kind of backside of this, and all of a sudden, people are waiting for the all clear sign, while a bunch of people are doing business, and they're going to realize it's fine. It's kind of like COVID. A lot of people waited around for the all clear, and other people were out doing business, and just saying, "Come on,
Yeah.
catch up. It's fine."
Yeah, for sure. I'll tell you, Graham Foreman, in my early days of investing, gave me two pieces of advice. And Graham is kind of a notable ed tech investor. And first he said, ask yourself if you're ready to lose money. It's kind of very candid. And the second, which I would also attribute to you, was he said, read Venture Deals by Brad Feld and Jason Mendelsohn. And I start with this point, Ryan, because there are the legal logistics that book covers, right? And the intricacies of how a deal is structured, right? It's not just to be an investor. Where do you sit on the cap table? How do you address dilution? All the more, complicated pieces of a deal. I think what I'm interested in your perspective is like, what are the key metrics that you're looking for, right? I'm not trying to get into the secret sauce of how you built the fund to where you have, but obviously it's more than a lunch, right? But what jumps out to you when you're sitting down and saying, look, this to me is interesting. This is something we should be investing in.
Yeah, it's one of the best things about Florida funders is, we've worked our tails off to get access to a lot of deal flow. And the more deal flow you see, it becomes easier and easier to notice a really good company. And you still have to be kind of open to it, and you have to, be able to look at it with a critical eye, and also look at it like, how can this go right? Like, what happens if they are right and things do go as planned? Like, what does this become? And so you're kind of looking at it from multiple lenses, but the more deal flow you have, the better off you're going to be, because you just start to see it, and so
Sure.
many get separated right away. And I think that's probably the number one difference between angel investors, especially ones who are just starting out. They see their first deal, maybe it's one of their buddies tells them about it. It's kind of like the cocktail party syndrome, and somebody tells you about something. Hey, I'm getting into this deal. It can sound pretty compelling, but that's like, if that's your first deal, or maybe that's like the only one you've looked at this month, like, it has a chance of sounding a lot more compelling than if you had looked at 250 like I might have that month. And to me, like, we get referred stuff all the time from people, that are our partners or in the industry or whatever, and even then, like, we call them A minus A deals and A plus deals, and there's so many great companies that are A minus or A deals for us, and they might be the right for somebody else, other investor, but for us, we only want to do that A plus deal, and when we see it, we kind of just know it, and so there's a lot of characteristics that come behind that. I'm happy to talk to you about that, but a big part of it is, you know not letting yourself fall into the trap, and we do this all day long, so it's like basically our job is looking at stuff over and over and over again, deal after deal after deal, and things can sound like, oh yeah, that's pretty interesting, I think that could be a pretty good investment, and you got to take a break and step back and be like, is that really going to be successful? And to me, like, I'm looking at stuff that's got to have huge upside, um, I'm trying to limit those zeros that you talked about, like how many are going to go to zero. Like I'm looking at all the ways it's going to go to zero. I'm looking at their competition, which may or may not be a factor. It's
Yep.
not necessarily a bad thing that a huge companies in the space, they're so big and slow. A lot of times you can make a lot of dent. Um, but like you're looking at the founder and like, do they have the characteristics you're looking for? Does the business model have the characteristics? Like, are they prudent with money? Like what have they done to date? If I see a company that, they're at $300,000 in revenue, what does that mean? That number doesn't mean shit to me. It's how fast has that been growing? If it took them 6 years to get out of the gate and finally get there, and now they've grown in the last 2 years from 0 to 300, like there's something not right there. And maybe there's a valid explanation, but 99 out of 100, it's just not the right formula because they should already be showing something taking off. Now, if they just went live 2 months ago and they've landed a couple contracts and they're at $300,000, like, whoa, now we got a story. Like let's dig in a little bit further there. So, it's not any one piece of information by itself. It's like, what is the meaning behind all that information? And that's how I have to digest it.
You find yourself going home and thinking about deals? Like, do you finish a day and you drive home thinking about deals? You wake up in the morning, you're still kind of digesting a deal. Is that normal?
Man, I sleep and dream in these deals. I woke up. I told somebody the other day. I was like, and this isn't even a deal we're looking at. It was one of our portfolio companies who's struggling with something. And I woke up at 3 o'clock in the morning. My 2-year-old's up. And next thing you know, like all I can think about is their business model and what could it be done. Like, and I'm trying to sort that out. And yeah, I sleep and dream in deals. Like, it's hard because you want to shut it off and be present with your family, but when you're like to do this right and have the kind of deal flow and process and pace that I expect from my team and our organization, the only way to do that is to be all in, and mentally it's taxing, man. It's taxing. I try to shut it down sometimes on the weekends and just completely think about anything but work because it's the only way I can function during the rest of the week when it's so intense.
I call them waterfalls. Ironically, I had one this morning where I wake up and it is the first thought that comes to mind, and I have to write it down. And today's was almost an hour. So, you know, I'm sure you're like me with dad time. Like my days start much earlier to get any sort of quiet time. And it's, and you can't stop them, right? I got to just ride it. Some stuff comes out and it's like, that's pretty good. Some comes out, I'm like, I didn't think about that. Some stuff, I'm not doing that, right? But at the time, you just kind of let it flow. And I find a lot of business owners, leaders like yourself, like this is the norm. Like it's unrealistic that you just walk away and you're like, all right, business, I'll see you in the morning. It
Yeah.
just doesn't work that way.
No, I've got a notepad next to I keep my
Yeah,
phone like with the note section and just, all hours of the night, putting stuff down. It's the only way I could sleep is by getting it out. 'Cause if I try to remember it, and that just keeps me awake all night long. So,
completely.
yeah. And then the next morning, I'm like, what was that gibberish? Sometimes I'm like, damn, that was brilliant,
Yeah. We speak to a lot of founders and we do hear a lot about fundraising, right? And it's probably got some people overhype it, right? So hard. Some people maybe oversell it. Like, look, we had some people knocking down the doors, right? We couldn't keep money off of the investor table, right? It was like, okay. And I think my view is that all funds have money, right? And the value is really in the experience that the VC can add to you, right? Because you can raise, for the most part, money anywhere. It's who you want to get married to. And I tell that to every startup company I meet, like, don't just take money from anybody. You wouldn't marry anybody. And they're like, oh, yeah, right? Like, huh. If you were raising money, right? If like change hats, right? You are now looking to raise money. How would you do it? Like having sat out now on the other side of what thousands of deals, there's got to be some commonality of like diamond cut opportunities.
Diamond cut. That's funny. So, uh, yeah, I mean, there's no like certain formula, I'll say, and if you're good and you have a really attractive business model, you're gonna have more than one investor interested, and that's where I think you want to be even more and more selective with who you get married to. And for others, I mean, maybe they're not as good, or maybe just the business doesn't have the characteristics yet, and you just got to take what you can get, and be careful. But you're a founder. You got to do whatever the hell you can do to keep it going, and your employees are counting on you to go raise money. So, like, for each person, that answer is probably a little bit difficult. But in an ideal world, you've got a bunch of investors interested, and you're be able to be selective as to who you want to work with, and you're picking people that are, got great reputations. They're going to dig in and help you to the degree that you need it or want it, and are going to support you. And it's not just support now; it's what are they going to do for you in the future? What about the next round? And do they have, a good brand name and reputation that others are going to want to work with them too? I mean, there's some investors you partner with them and nobody wants to work with them. So,
Mm.
you've kind of really written it off at that point. But one big thing I'd say there's
If you were
a
doing it,
couple
right?
different
Give me
things.
like
Yeah,
what
yeah.
would you do, right? If you're starting a business.
Well, first, be prepared and have a deck. And that sounds so like, duh, of course. But, like I told you, I see 2,000 deals a year. So many of them are not prepared, or they'll come in and be like, oh, this is my first time ever pitching. What do I do? Or they try to dictate the room. Like, the best thing or the worst thing you can do as a founder is tell the investor, here's how we're going to do it. Because they may, like for me, I've got thousands of deals I'm seeing. So there's a process to it. The only way we could survive is with a process, and we see stuff every day. So when you do something totally outside the norm, it's not like you're trying to stand out at a cocktail party. To me, I'm trying to analyze you in a way and give you the fair credit and ask the right questions. And if you're trying to do like a conversation, some people that works. Other people, like I like to go through a pitch, because if I see the pitch, it already is allowing me to kind of compare you to a mental process, compare you to others, compare you to like everything that I need to see, and it makes me like go through my mental checklist as we're going through the questions. And if you have that, I'm going to be able to get more and more comfortable. So one of the first things I would do, there's a lot of different great resources out there as far as decks, but have the right deck that really explains it. And what I tell people all the time, take it to your spouse, take it to your mother, somebody who's not in the business, that you trust, and hand it to them or pitch to them. And if they don't get it, and if they have a bunch of questions like, not sure I really understand what you do or what you're trying to do, like it's not right. Like you've got to start like to where
That's a
you're,
great idea, man.
a teenager should be able to easily understand this. Your mom should easily be able to understand everything you do, and there may be far more deep technical things you could go into that maybe that person's just not right to understand, and that's fine. But if they can't get the baseline, then I guarantee when you're trying to pitch the investor, they're not following you. And it's unless you're going like, hey, we're a ed tech group and we're pitching to an ed tech fund, that's a little different, right? But if you're coming to most of the VCs out there, because there's only a few ed tech funds at the certain stage that you're at, you need to be able to explain to somebody like, hey, we're going after the K through 12 market. Here's like what our business model is, and we have to go in through, like, I don't know whether you go sell at this at the school level, the district level, the state level. Like, don't assume I know any of that. Just walk me through it like I'm a dummy. You're not going to insult me, and I'll give you signals as to kind of mentally where I am, and we'll gradually ramp up and get there. But if I don't understand it from the start, and this happens so often, you're 20 minutes into the pitch, and I'm like, hold on, time out. Like, what what exactly are you doing? Like, what is exactly the business proposition? And you realize it's at that moment that you've been talking for 20 minutes and the investor hasn't followed any of it. And the odds of you getting a yes is like almost zero at that point. So, if it's me, I'm having a very clear deck that answers, here's the problem I've identified. Here's the solution. Here's why I'm the right group to do it. Maybe here's my background. I came out of ed tech. I realized this is a huge opportunity. I was working for another company. We saw this. They weren't attacking it right. And I have these industry contacts. They've already given me a pilot, and so we've got some traction. Here's the business model. Here's how we're going to make money. Here's what we're going to charge. Even if you haven't figured some of that stuff out yet and you're early, that's okay. Say, here's what we're thinking we're going to be able to charge. We've gotten some feedback from people. I've tested the waters, and then like that to me, like, oh, okay, all right, this person's really kind of, they know what they're doing. They come out of the industry. They've got a reason why I should be able to bet on them, and that business sounds pretty solid. And so like I'm already getting more comfortable, and that's going to form much better questions on my end because you're giving me all this stuff to help me understand it. But the other big
I
thing
never
here,
even contemplated, though, Ryan, that people would show up without a pitch that wasn't cogent. I don't mean that in a slight. Like, I just assumed that that's how it works. But I
you
guess you
would
see so many deals that you're naturally going to see the whole gambit.
you would think so, man. But it's sad that most people don't, and then they get, a lot of them are just, they're immature and they haven't been told the right way. So we try to get feedback to people like, hey, you know, it's not a fit, but here's what I would do in the future, and here's what I would do differently because I'm trying to help as many people as I can. I can't help everybody with a check, but I can at least give somebody feedback so they don't screw it up for the next investor that they talk to. The other big thing is too many investors are like, or founders just think that everyone's going to write them a check, and they get an intro to somebody and like they put all their eggs in one or two
Yeah.
baskets. And when they do that, they're like, "Oh, what do I do? Like I can't raise money. These stupid VCs don't know what they're doing. Like they're just dumb. Like Florida doesn't have any investors. I'm moving to California." Like you wouldn't believe the irrationality of people because they get a no. And the problem is like if you're a founder, you should be talking to at least 50 investors. Maybe you're really good and you're
Wow.
going to get it on the first, second, third, fourth, fifth try. But the reality is, you probably need to be talking to 30, 40, 50 investors. And even after you raise that round, your next round might be in 12 months. You're going to have to start that process 6 months before. And you better be talking to 50 investors for that round. And don't be talking to everybody. Talk to the ones that invest at that stage in your space, that like your type of deals, that invest in your geography, that you're gonna be at kind of a revenue area where they're looking. Like it's not trying to get access to every single fund because a lot of them you're never going to be a fit because you don't line up in the box. So find out where you fit in the box and then narrow that down and have 50 meetings, and then your odds of success go way up. If you think about all the people in the world. If you're trying to find a spouse, like you don't go to one bar and quit. Like the first girl you ever talk to and she's not interested in you, like okay, so what? Like there's a million other people in the world. There's a billions of people in the world, right? Like it's a matter of finding the right person for you, and it's the same thing in investing. You
Let
can't
me
just
ask
shoot one
you,
shot and be done.
without and no names, do people get spicy when you tell them, "Hey, we're not interested"?
Yeah, some do. I mean, I think it's funny. The ones who have been doing it, they're kind of used to it, and I think it's the professionalism and how you handle it. I mean, it's definitely my first couple deals. I probably didn't handle it as well. I was trying to find my own way and seeing how other people do it. And some people do it have different styles. And to me, like at least for the last 4 years, let's subtract that first 3 4 months. I try to give people help and true feedback. And the more founders I've talked to, the more they say, like, I just appreciate you telling me like the real reasoning why you're passing, giving me real feedback. I'm a big person, I can handle it, and not bullshitting people. Like that's the worst thing. Just it's just not a fit because of the valuation. And then like, you know, you learn real quick. People are like, well, I know I asked for 20 million valuation, but I'm willing to take five if you'll fund me. And now it's not about valuation. And you're like, well, it's still not a fit. And like, well, why? You just said it was because of valuation. Like you trap yourself as an investor
Yeah.
if you give bullshit, because people, smart founders, gonna be able to see right through that. But also, like, what does that do? It doesn't help. And if it's truly just not a fit for us, like there's a lot of times it's just not, but I'll tell somebody, here's the reason why, or here's another fund that I think might be worth talking to. And you just do your best you can to be real with people and treat them like
The
you want to be treated.
valuation feels like a game, right? Like I met with someone yesterday and said, okay, how you raising money? I encourage them to use a safe, right, for where they were. What valuation you come up with? No revenue, no implementation, no, like $10 million. And I don't know what to say, right? I mean, maybe, uh, is that part of your job in the sense of like getting them to see a little bit of reality?
Yeah, 100%. I mean, it's definitely my job, but it's hard because at each stage there's a weird balance and venture, right? Like before I got into the business, to me it seemed like if I'm going to invest, let's say $1 million in you and you're just beginning, like I want as much ownership as possible, like how about 50-50? We'll split the company. I'll put up the money, you get the company. The problem is that if it's in venture, you're raising money in future rounds, and the future investors want to see that those founders have enough carrot of dangling in front of them, meaning ownership, that they're going to want to continue to show up every day and do this grind for 7-8 years and not get burned out. And the one way you ensure that is there's enough upside there for them. So if you take too much equity at any one stage or some kind of weird preference or term, you kind of you shoot yourself in the foot because then you're going to make it really hard on the company to raise money in the future rounds, which means your investment's going to be at risk. And when they run out of money, at some point, usually most of these companies go from 6 months, 12 months, 18 months, and they got to raise another round. And if you've made it really hard on them to raise another round, now your investment's either going to go to zero or you have to put up the money and keep putting up the money. And so you got to be real careful of not setting yourself up to be in a bad position, setting the company up to be in a really bad position. So it's a interesting dynamic of how that plays out. And so to me, to answer your question is like, what's a company worth at the early stages? I'm looking at like what's the upside. So I'm kind of I'm starting with backing into it from where do I think if things go right, if things go decent, what are they worth? And I'll put some sort of multiple on that depending on the type of business. So we only invest in recurring business, B2B SaaS type of business. So if you use a 10 times multiple there and you figure, okay, this company, I think it can get to $20 million a year in revenue, there's a pretty good shot at that. Um, then, okay, these guys can exit at 200 million. And that's probably it's going to take them at least 5 years to get to a $20 million run rate. And if it's going to take them 5 years, they're probably going to have to raise another round or two, at least to get there. And so to get to a $200 million valuation, and here's all the risks along the way of them going right or wrong. Like, what do I need to come in at now? And maybe they have one customer and that $100,000 a year in revenue. Like, okay, I can't invest at $15 million or $20 million or maybe even $10 million. Now, if they're at $1 million run rate, like some of that proof point is already there. Now it's a
Sure.
matter of scaling. So it's like, okay, at $1 million run rate, I can get to 10 or $12 million valuation and now I've got basically to 20x that return. They're going to go from 1 million to 20 million revenue. I mean, that's a big jump, but they've already proven out a lot of the thesis for me. So, and if they come in at $1 million of revenue right now, nobody's going to buy them for 10 million unless they have some fabulous tech, but they're probably going to be able to sell for 5 to 7, and if they can kind of grow it over the next year or two, I know they're probably going to be able to get to a place where they're at $2 million in revenue, even if that's as far as they ever get. And at 2 million, they're probably going to be able to sell it for 10 million. So I've kind of figured out, okay, my risk, my downside is kind of losing half the money. My upside is really 20 times. Can I get comfortable at 10 to 12 million valuation? Does that make sense?
Absolutely. I've never heard it broken down that way. That's powerful. One of the
Yeah, you
things,
got to back into it because a lot of people come in and they're like, oh, it's $25 million valuation. Like, well, where are you at revenue wise? Well, we got a couple customers. We think we'll be at $5 million a year run rate by the end of this year. I'm like, okay, where are you at right now? Well, I'm at 500,000. Like, so you're gonna go from 500,000 to 5 million, and we see it all the time, dude. Like, I know you laugh and it's funny, but like all the time we see this, and it's like, no, you're not. Like, a very select few do, but 99 out of 100 are not going to be able to do that. And so like, you're looking at realistically, where are you? And I'm not paying you a future valuation for your future growth on top of that. That's like a multiple on a multiple. I'm going to pay you a multiple on where you are now, but I'm not going to pay you a multiple on where you're also going to be in the future. That's probably one of the biggest mistakes founders do is they try to base the valuation on where they're going. And it's like, oh, that's great. So I'm going to pay you for the future, and there's no room for error. And now, so a year from now, you're finally everything goes perfect. You've gotten to where you said you were going to be, and I've sat there, and now all of a sudden the company's actually worth what I invested in a year before that. Like that doesn't work. So if you're a founder, man, you gotta be thinking that way in terms of what the investor's doing. And I don't know. I just wish more founders understood that because it would make things a lot easier. But well, that's part of the fun too.
on the revenue side, and I laugh because now I don't think I've ever seen a pitch deck where the arrow wasn't straight up to the right? Like, and the first year sales, like it's on a bar chart and it's really, really small. And the next year, it's like, are we gonna get this investment? The next year, it's like it's a substantially bigger bar. And the year after that, it's this like huge bar. It's like 100,000, a million, 20. And you're like, wait a second. How can that happen? Like, that's where you come in. I'm like, I think we're good, but that's aggressive.
Yeah. Yeah, I think that bothers me less than people that just have no idea about their financials, and unfortunately there's so many people giving advice, some good, some bad. I think unfortunately for founders, their heads are spinning a lot of times. They're like, who do I listen to? Someone told me to do this, someone told me to do that. So from me, I like to see, and I've never had anybody get in trouble using this methodology, is here's my here's my expected where I'm going. Like here's the expected forecast for the year and next year. Here's where everything goes right, and like we could hit. We're gonna hit $1 million in revenue by the end of the year. No matter what, I'm willing to back that. Like there's no chance we're missing a million. If everything goes right, we're gonna hit 2.5 million this year and 7 million next year. And if everything goes wrong, we're going to be at about 750,000 in revenue this year, and we'll hit 1.5 million next year. Like we're really going to have to miss, but that's kind of the floor. And I think when you do that, you're showing the investor you've kind of thought of the different scenarios, and there's a baseline that I can plan for. But then I can also see the upside. Like, wow, this is exciting. If things start to go right, this thing could be huge, and I want to see that. So one mistake founders do a lot is they're way too conservative sometimes, and they'll tell me like, we're at 500,000 in revenue right now. It's just about to be the beginning of June. We're projecting to get to 700,000 by the end of the year. I'm like, really? That's all you're gonna get to is 700,000 by the end of the year? Like, well, no, not really. I think we're actually gonna hit 1.5, but I'm just, I'm hesitant to share that because I don't want to seem overly aggressive. And it's like, well, that's the wrong mistake. Because if I think you can only go from 5 to 700, you're just not gonna be able to grow fast enough to generate the returns we need. And so it's this balance of being realistic, but having enough upside to show this that your thought process is credible. The reality is you're not going to hit the projections anyway. I don't care. Like if you tell me one number, if you're not hitting that number, it's more, are you heading in the right direction?
And the methodology to get there.
Yeah, yeah, for sure.
You know,
And the
we
and the
talk a
more
lot about
thought you've had, like the more you can deal with variables that come along. Like, okay, Silicon Valley Bank happens, the economy goes to crap. Like, were you flexible in your thought process to account for multiple scenarios? Okay, we adjust. We're gonna have to adjust on the fly. And so, like, the more detail you've given me into your thought process, the more comfortable I don't know what it is that's coming around the corner in a month from now, or 6 months from now, or 2 years from now, but it's coming. Something's coming, good or bad. I don't know. But how's that going to affect you? ChatGPT comes out. Okay, great. Like, how does that affect your business model? Things are moving constantly, and you got to be flexible. If you have a rigid plan that there's no room for error, you're done.
Powerful. Absolutely. There's a there's a part of the story, Ryan, that we spend a good chunk of every episode on, which is that journey from idea to enterprise. And while you're not a founder, right, or in that sense, your story of how you've reached the apex in your career right to this moment is about fortitude, right? You traverse the path to the top. And I think, some of those early ventures, they didn't play out the way you had envisioned them, right? You did go back to school later in life and you grinded through those early deals to prove you had the qualifications to reach where you are today. How does that how does that advise your work today at Florida Funders? Like how did those experiences shape you as you grow now into frankly one of the preeminent VCs in Florida?
Thanks, man. I appreciate that. I think part of it has hardened me a little bit to where I don't have sympathy for people that just expect it all to happen and aren't willing to put in the work. Um, Part of me, it gives appreciation to the people that are putting in the work and maybe give them the break that I so desperately crave for a long time. Um, to me, like, I never gave up. I knew what I loved to do, and I knew that it was just a matter of getting the right chance and the right door to do it. And then it was like kind of a F the world mentality. Like, I'm gonna prove you wrong and show everybody who said no to me over the years. And I think, a lot of founders are that same way. And the best ones, um, like, you can tell them no 100 times, and it might bend, but it's not gonna break them. And it can be discouraging, but it's if you know what you're doing and you believe in what you're doing and you really believe in it, and there's a real credibility. I mean, if I had never gone to any sort of schooling and I believed I was going to be a VC, like, that's just not a credible theory, right? But like, there's like a backbone there. There's a support that says, okay, I could be qualified for this. Maybe I'm doing it a little bit different than some others, but I knew the characteristics were there. And I just I got great advice from Glen Oak and from Mangrove Equity Partners here in Tampa. I was trying to break in the 2010 timeframe. Um, we're just coming out of a recession. Nobody's hiring, and he's like, "Dude, you just need to do some deals. And if you do the deals, then you have a track record, and the track record is going to speak for itself, and no one can tell you no after that." And that really resonated with me. And I knew I wasn't gonna just be able to do that. Like, you can't just like turn it on one day and start doing deals. You gotta there's like a baseline there, and I kind of developed a plan to get there, and I ended up going to law school. I was working on a very complex deal to acquire a distillery out of bankruptcy, and I realized at that moment I was kind of humbled because I said, I really don't know what I'm doing on this portion of it, and I may know how to do this part and this part, but like, I don't know how to do this third part, and this third part, to me, like, damn, if I can figure that out, I'm gonna be unstoppable. And kind of the worst case is I'll have this other education where if maybe venture really is never gonna happen for me. At least I got a backup plan. I'm not just pedaling the street corners for an opportunity. And maybe my dream's just not gonna happen. I never gave up, but I had a backup plan, and so I got more and more into it, and I took a very different route. And people, I'll definitely say there was eyebrows raised when I was going through law school. Like, wait, you're not going to work with your dad? Your dad's one of the premier trial lawyers in the entire state of Florida. Like, the hell are you talking about? And I was like, I've got a plan, and this is my plan, and I'm going for that plan. And if it doesn't work out, then we'll see what happens. But I just, I had had a plan and I stuck to that plan and I just kept grinding away and got a few chances that weren't exactly what I wanted, but I took those opportunities and ran with them, as a sponge and learned things that, other people don't and people that go maybe the traditional route. Um, I think that's great if you can get in and you take that and run. I learned it through a different way and it gave me a different skill set. Frankly, it gives me a different lens and I think is why it allowed me to look at things differently and do things a little bit differently and challenge the status quo. I mean, honestly, this business has a lot of lemmings, and that's never been me, my personality. You look at the very best, the Peter Thiels of the world, they're contrarians at heart, and I think that's been a blessing to me is not being able to go maybe the traditional route and thinking the same way that others do. You got to be able to see things a little bit differently for good and bad. Sometimes it's a no when everybody else is saying, "Hey, this is a great deal,"
Right.
and or guys, I know this. There's a lot of reasons why this might not be the right deal on the surface, but this is the reason that we need to make this bet. And the best part about this business is at the end of the day, there's a very real measurement of it, and you're either gonna be good at this business or you're not. And there's no bullshitting here a couple years down the road because if you're if you're really good at it, your track record's going to show it, and if you're not, your track record's going to show it. So you find out pretty quickly whether or not you can make it.
How do you take inventory of progress? Right? Like, I don't mean money. Like, how do you think about when you reflect back, even in the last 2 years, like, what's moving the needle for you?
For me or for a
Yeah, for you
company?
personally.
Um, that's a great question. I think obviously I've got our KPIs and things like that, and how many deals are we seeing, and a big thing for me was kind of the making sure the reputation of Florida Funders, how we treat people, is there, and my reputation. Like at the end of the day, like a lot of times we're all at will employees, so like I want to make sure that everything I do and everything I do in life, I'm living up to the family name and treating people right. I want to be able to look people in the eye and you know when I look at this business, I tell 99 out of every 100 people no. And it's a lousy feeling in a lot of ways. And the only way I can reconcile that personally is to treat people right. And it feels good when you go in because it's hard because it's a small community. You go into Embarks or something like that, and there's a lot of founders in there that are working their tails off and doing a great stuff in order to build a business. And a lot of them I've told no to, like it's just not a fit. And so the only way to do that and is to treat people right and hopefully help them along the way, even when it's not necessarily an investment help, but it's other ways you can help. And um, I look at founders and if they'll refer stuff to us, like that's progress to me is people respect the job that I do and that we do here. And they're saying, "Hey, I want to work with those guys. Those are good guys." And we get other firms calling us all of a sudden. Like the phone didn't ring as much when I started here. And now, like it's not a week goes by that there's some firm from the West Coast or New York or whatever that's saying, "Hey, we heard a lot about you guys, and we're going to be in town. We want to meet you. We're really interested in one of your portfolio companies." Like that is the validation that is really exciting. I mean, my favorite company right now moved here to the U.S. from Australia, and I'm like, "How the hell did you find us, man?" And he's like, "Well, I was looking, and I was thinking about either Silicon Valley or Austin or Florida, and every time I looked at Florida, like you guys' name just kept popping up, and so." And it was like nothing but good stuff, and I reached out, and the best thing is being able to say, not, "Hey, go talk to this founder and see if there's some credibility, like they'll validate what we do here." It's, "Here's our portfolio. I don't care which one you pick, but here's the ones that I've worked with." I can't speak for the ones that were kind of done before me, right? But the 80 deals that I've done since I've been here, I don't mind saying, "Hey, go pick any one of them." And if you talk to any one of them, talk to two or three, and whatever they say, like I feel confident they're going to tell you good stuff about working with us. And that to me is the measurement.
Look, I'll attest. I met Florida funders while you and I were working together, and I can remember
Mm.
talking to you about them. And he was like a cool guy, Tom. And I met this other young guy, Saxon, and they were. I'm sure there was more to it, but those are the people I met, and it was a small op in Tampa. Great name, and they were really talking about things that I historically had put into the market of Silicon Valley, and maybe just a lesser extent New York. And this was conversation happening here, right? And then did my first deal. I was like, oh wow, like this is real. And to see the progress made, when I'm in Miami and people are saying, oh, Tampa, Florida funders, when you're credibly being spoken about in Tallahassee. I mean, you're making a wave. I know you're a part of that wave, but it's been an incredible journey to watch. Ryan, what a fantastic episode. We get everybody out of here with a fast four and just rapid answers, right?
All right.
As an entrepreneur, which you are, right? What trends are you watching? What excites you?
Oh, we froze.
You're good.
Okay. Um, Man, the job I do, it's never about what excites me. It's about what scares me. That's the way I feel like I'm better. So I'm gonna answer not what you're asking me as usual, but I think the upcoming election next year is going to create a lot of noise, and there's going to be a lot of things happening domestically and globally. And I don't think we've heard the last of some of the banking stuff. I don't know if it'll be as bad as everyone thinks, but I think there's just a lot of noise over the next year and a half, and I think that it's going to be batten down the hatches a little bit and be smart about how you're deploying money, and that goes for funds and for founders. Be conservative, grow, don't stop growing, but be smart, don't be stupid.
One place in the world everyone needs to visit.
Man, I mean, I'm obviously here in Tampa, and I'm partial to that. I've always kind of felt that way, but locally in Miami, like I'll just say for the spirit of this podcast, if you're a founder or an investor and you haven't been down to Miami yet, like at least go check it out and see what's happening there. And it may not be the right place for you, but it's pretty sticky. And I'd say most people I see are not getting that return flight home. They're buying a place, renting an apartment, and it's a sticky place, man. Once you're there, you don't get out.
Greatest area of growth for you in the coming year?
We've got this big fund three. So if we can raise this fund three, there's not very many $100 million seed to Series A funds in the Southeast, let alone Florida. And so that's a big mark for us to hit. And there's no stopping all the companies that are coming here. I know we can find the best companies. It's just how much money do we have that we can put in them, and over time there's going to be amazing returns coming out of what we're doing. It's just, there's some patience required there. It doesn't happen overnight in what we do. This is not a, invest in, hey, good news, last month that company we put it in, I 10x your money. Like it just doesn't work that way. But if people give us a chance and some time, it's going to be unbelievable.
Favorite podcast that everyone should be listening to?
Well, other than this one, of course, I like the Jason Calacanis.
Okay.
I did the All In podcast. Those guys. I like the fact that it's not just all about venture, but they're really intelligent and they're feisty. They think about a lot of different things, but I think you have to be able to accept other opinions sometimes and think
Mm.
deeply about what's coming down the pipe. And if you do that, you can be more prepared. And they challenge my thinking a lot, and I like that.
Ryan, thank you for sharing an incredible story. We really loved having you on the show, and yeah, thank you so much.
Appreciate it, man. Enjoyed it. And now let's finally get that golf game going that we've been talking about.
7 years in the making. It's time.
Have a good Memorial Day, buddy, and thank you to all the servicemen, men and women out there that lay it on the line for all of us to do what we do. Man, that's the ultimate thing right there. It's what people do for this country. So appreciate it, and have a Memorial Day.
Thank you for joining today's episode of Capital Class. If you're interested in joining our next discussion, subscribe on Apple, Spotify, or any of your favorite podcast platforms. Capital Class is a venture with the Strategist Podcast Network. To view the entire lineup of shows, visit strategistgroup.com. I'm Adam Geary. Class is closed.